Welcome back to the Daily Crypto Roundup. Today is one of those sessions where the surface-level price action only tells half the story, because underneath it, there's a lot going on that explains why the market is behaving the way it is right now, and more importantly, what that might mean over the next few days and weeks. We're going to break down why Bitcoin and Ethereum have pushed higher again, what's actually driving this move beyond the usual ETF headlines, why certain altcoins are starting to wake up while others still lag, and how institutional behavior is quietly reshaping the market structure in a way most retail traders are still missing. Before we get into it, a quick note. We've been going through the comments today, and it's genuinely great to see the level of interaction picking up. New listeners, regulars who've been here from the early days, people disagreeing, people adding context. That's exactly what we're trying to build here. This isn't just a broadcast, it's a conversation and a community, and it's good to see it starting to take shape properly. And as always, don't forget the XRP giveaway. We'll be doing another small XRP drop for commenters, so if you want to be in with a chance, make sure you're dropping your thoughts below. Bullish, bearish, it doesn't matter. We want you to be part of the discussion. Right, let's get into the market. As of today, the total crypto market has pushed higher again, with broad-based gains across majors and a noticeable improvement in sentiment. This isn't a single coin rally. Participation is wider, and this matters. Bitcoin is trading at approximately $95,100, up just over 3% on the day. Ethereum is stronger, sitting near $3,295, up around 5%. XRP is trading at $2.12, up roughly 3%. Binance Coin is at $933, also up about 3%. Solana is at $144, modestly higher on the day. Tron is trading at 30 cents, slightly up. Dogecoin has had a stronger session, up over 5% at 15 cents. Cardano is also higher, trading around 41 cents, up nearly 6%. Avalanche and Chainlink round out the top 10, both posting solid gains, though neither is leading the pack today. So the immediate takeaway here is that this isn't Bitcoin dragging everything else along reluctantly. Ethereum is outperforming, mid-cap majors are moving, and meme coins like Dogecoin are seeing renewed interest. That tells us something about risk appetite. Now let's talk about why the market looks like this today. The first layer is macro, and whether people like it or not, macro still matters. US inflation data released today came in broadly in line with expectations. Nothing dramatic, nothing scary, but crucially, nothing that forces the Federal Reserve into a more aggressive stance. That matters, because markets have spent the last 2 years swinging between fear of tighter financial conditions and relief when those fears don't materialize. Today fell into the second category. The inflation print didn't give the Fed a reason to shock markets, and risk assets, including crypto, responded accordingly. But that alone doesn't explain the strength of the move. The second layer is flow-driven, and this is where things get more interesting. Bitcoin spot ETFs saw another strong day of inflows, with roughly $750 million moving into these products in a single session. Ethereum ETFs added another $130 million on top of that. Now here's the key point that often gets missed. This isn't just money moving around inside crypto. This is capital coming from traditional finance structures that can't easily exit and re-enter on a whim. ETF flows tend to be stickier than exchange flows, and that changes the character of rallies. At the same time, the market saw a significant short squeeze. Roughly $590 million in leveraged short positions were liquidated across major exchanges. When you combine strong spot buying with forced buying from liquidations, you get exactly the kind of price action we've seen today. But what really separates this rally from some of the more fragile moves we've seen in the past is who is doing the buying. According to on-chain data and analyst commentary, this rally is being led primarily by spot demand, not leverage. Will Clemente put it bluntly earlier today, saying that Bitcoin's current move higher is being driven by real buyers, not speculative positioning. That matters. Spot-led rallies tend to be slower, steadier, and more durable. They don't collapse the moment funding rates flip or leverage unwinds. And there's another data point that reinforces this. Over the past 6 months, corporate treasuries, public and private companies holding Bitcoin, have accumulated roughly 260,000 Bitcoin. Over the same period, miners produced only around 82,000 Bitcoin. Companies are buying roughly 3 times more Bitcoin than is being mined, and that cannot continue forever. That supply imbalance doesn't show up immediately in price, but it does show up over time, especially when selling pressure dries up. MicroStrategy alone now holds close to 687,000 Bitcoin, representing roughly 60% of all corporate Bitcoin holdings. Love them or hate them, that's a meaningful structural force in the market. This supply dynamic is why some analysts are increasingly confident that dips are being absorbed faster than they were even a year ago. Now let's zoom out slightly and talk about market structure, because this is another underappreciated piece of today's story. Bitcoin derivatives markets are evolving. For the first time, Bitcoin options open interest has overtaken futures open interest. Options now represent roughly $65 billion in open interest, compared to around $60 billion in futures. Now the question is, why does that matter? Because options are often used for hedging and structured exposure, not just directional bets. Even more interesting is the fact that BlackRock's Bitcoin ETF is now responsible for over half of the open interest in Bitcoin options. That tells us institutions aren't just buying Bitcoin. They're actively managing exposure, protecting downside, and planning for volatility. That's not speculative froth. That's market maturity. Now, none of this guarantees that prices only go up from here. But it does change the probability distribution. As long as Bitcoin holds above the $94,500 to $95,000 region, many analysts believe the path of least resistance remains higher, with the psychological $100,000 level back in focus. Some traders are already assigning a near 50% probability that Bitcoin tests 6 figures again within the next few weeks. Ethereum, meanwhile, is quietly setting up its own narrative. Ethereum has outperformed Bitcoin today, and that's not accidental. Analyst Garrett Jin suggested earlier that Ethereum has entered a new impulsive wave, with longer-term targets extending significantly higher if momentum continues. Whether you buy those exact numbers or not, the important point is that Ethereum's strength tends to precede broader altcoin participation, and that's something worth watching closely. Now let's talk about some of the more interesting stories from outside the usual ETF conversation, because there were a few today that deserve attention. First up, Coinbase. Coinbase announced that it will be listing Radium, the Solana-based decentralized exchange token, for spot trading. Radium reacted immediately, jumping around 7% on the news. This matters less because of Radium itself, and more because it shows Coinbase continuing to expand its Solana ecosystem exposure. Listings still matter. They still drive attention, liquidity, and narrative, especially in a market that's starting to wake up again. Next, Algorand. The Algorand Foundation announced it's moving its headquarters back to the United States, relocating from Singapore to Delaware. Alongside that, it revealed new board appointments, including figures with deep experience in fintech, compliance, and payments. This is part of a broader trend we're seeing. Crypto organizations positioning themselves closer to US regulatory frameworks rather than avoiding them. Whether that strategy pays off remains to be seen, but it does signal a shift away from regulatory arbitrage toward regulatory engagement. In Europe, another important development flew slightly under the radar. Crypto infrastructure firm Crossmint secured a MyCA license from Spain's regulator, allowing it to operate across all 27 EU countries. With MyCA fully coming into force this year, firms that get licensed early gain a significant advantage. This isn't exciting in the short term, but it matters for adoption, payments, and institutional integration, especially in areas like tokenized assets and crypto-enabled commerce. Now, one of the more unexpected stories today came from prediction markets. Trading volume across crypto-based prediction platforms hit an all-time high, with over $700 million in volume in a single day. US-regulated platform Kalshi accounted for the majority of that activity. Prediction markets are quietly becoming one of the fastest-growing crypto use cases, blending speculation, information markets, and real-world events. Major wallets and exchanges are beginning to integrate them, and despite regulatory pushback in some regions, usage continues to grow. That tells us something important. Crypto adoption doesn't always look like payments or DeFi. Sometimes it looks like entirely new financial primitives finding product-market fit. Now let's briefly touch on regulation, because there were meaningful developments today that will shape the market longer term. In the US, a long-awaited bipartisan crypto market structure bill took another step forward. The proposed legislation aims to clearly define which assets fall under securities law and which fall under commodities regulation, potentially shifting oversight of spot crypto markets toward the CFTC. One controversial provision would prevent stablecoin issuers from paying interest on holdings, a move supported by banks but criticized by crypto-native firms. Whether this bill passes in its current form is still uncertain, but the fact that serious legislative work is happening at all is a change from years of regulatory ambiguity. Internationally, Russia signaled a significant shift by preparing legislation that would integrate crypto into everyday financial activity, including payments for utilities and public services. While geopolitical considerations make this a complex story, it reinforces the broader point that crypto adoption continues globally, even as regulatory approaches diverge. So, where does all of this leave us? The market today isn't moving because of hype alone. It's moving because macro conditions didn't deteriorate, institutional flows remain strong, supply dynamics favor buyers, and market structure continues to mature. That doesn't mean volatility disappears. It doesn't mean corrections won't happen. But it does mean the foundation under this market looks sturdier than it did during previous rallies driven purely by leverage and speculation. As always, the key levels matter. Bitcoin holding above the mid-90,000 range is critical. Ethereum maintaining strength relative to Bitcoin is worth watching. And altcoin participation, especially outside the top two, will tell us whether risk appetite is truly expanding. We'll keep tracking it all. Thanks for listening, and as always, we'll see you at the top.